Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest tiny G updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at noon, 7 p.m. Eastern Standard Time. And here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in the daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Well, ladies and gentlemen, something unexpected just landed in the world of crypto and finance. No flashy press releases, no headlines on Bloomberg, no Wall Street ticker flashing red, just a quiet, unassuming patent filing. Yet hidden inside that legal document lies a story that could reshape how trillions of dollars move across the global financial system. And in the fine print, two names stand out, XRP and Stellar. And at first, it might seem like just another attempt to link crypto with traditional banks, but this isn't some hype. This patent hits at something far bigger, a potential blueprint for modernizing global finance itself. If even a fraction of what's described here becomes reality, XRP and Stellar may not just be digital tokens, they could become the plumbing of the new financial system. Before we get into it, I just want to thank everybody that likes, subscribes, and comments and shares. These few things really do help us out, and I appreciate it. I love commenting. Also, if you're new here, please do subscribe and realize at the end of our videos, there's a rant that people have come to love, and I'll see you on the other side. Ladies and gentlemen, to understand why this matters, we need to zoom out. Global finance moves a mind-boggling amount of money every single day. Yet despite smartphones, instant payments, and real-time messages, much of the system is still stuck on infrastructure designed decades ago. Stocks, bonds, derivatives, and cross-border payments all operate on different legacy systems. Settlement times for international transfers can still take days. Liquidity often gets trapped, unable to move freely between markets. Think about this. The world economy generates roughly $100 trillion in GDP per year, yet single institutions process amounts far beyond that in transactions every year. These outdated systems are why blockchain adoption is no longer just a tech trend. It's a necessity for modernization. Let that sink in, ladies and gentlemen. Blockchain promises to move value across networks almost instantly, reducing delays, lowering costs, and opening possibilities for new forms of liquidity. And now we're seeing institutions quietly building the systems that could finally bring that promise to life at scale. I want to talk about a few historical financial examples. History has a way of repeating itself, but with a digital twist. In the 19th century, the telegraph transformed markets, allowing traders to send price information instantly. In the 1970s and 1980s, electronic trading systems replaced paper-based exchanges, revolutionizing speed and efficiency. The rise of derivatives and complex clearing systems brought liquidity, but also complexity. Each leap in technology reshaped how markets function, often quietly at first, only later becoming obvious to everyone. Now, blockchain and tokenization are the next step. They promise real-time settlement, programmable liquidity, and global interoperability. Let this sink in. This is massive, so massive. And just like those previous financial revolutions, the first signals often appear in technical filings and patents, not in headlines. Let's talk about the patent filing. This brings us back to today. A newly filed patent mentions XRP and Stellar implicitly, suggesting these networks may play a central role in a next-generation liquidity infrastructure. But what is this patent actually describing? At its core, it envisions tokenizing traditional assets, stocks, bonds, ETFs, commodities, any asset that represents value. Once tokenized, these assets can move across distributed networks almost instantly. The patent introduces the concept of digital liquidity tokens. Let this sink in, marinate on that. If that sounds technical, think of it this way. Imagine a market where you don't need a buyer and seller to create liquidity. Instead, liquidity is built into the system itself, ready to move whenever it's needed. This is exactly what automated market makers, AMMs, do in crypto. But the difference here is that this could operate at the institutional level, bridging multiple markets and asset types. And that's where XRP and Stellar come in. I want to talk about the role of XRP. XRP Ledger is designed for speed and efficiency, about 15,000 transactions per second, settlements in 3 to 5 seconds, transaction fees just a fraction of a penny. Its primary focus, moving liquidity across assets quickly. In the patent, XRP could serve as the bridge between different tokenized assets across networks. Instead of relying on banks to create liquidity, XRP could help the system route value instantly. Let this sink in. This is huge. Imagine trillions of dollars in tokenized stocks, bonds, and commodities moving in real time. The XRP ledger could be the digital backbone making it possible. I want to talk about the role of Stellar. Stellar, XLM, on the other hand, has a slightly different mission. I know some people hate Stellar, but still. Optimized for global financial access. Enables fast, low-cost access instance. Enables fast, low-cost asset issuance. Supports tokenized currencies, digital securities, and stablecoins. Where XRP focuses on moving liquidity, Stellar is about creating it and distributing it efficiently. That combination is powerful. XRP handles the speed and routing of liquidity. Stellar enables assets to exist and move across the network seamlessly. Put together, these networks could form a bridge between the old world of finance and a new tokenized economy. Ladies and gentlemen, but here's where things get even more interesting. This isn't about just two networks. This is about a fundamental shift in how money moves globally. At the quiet filing of a single patent, maybe the earliest hint of a massive financial infrastructure upgrade. Interoperability in the multi-chain world. This is huge. One of the biggest challenges in tokenized finance is interoperability. Tokenized stocks on the blockchain can automatically interact with bonds on another blockchain. Without bridges, liquidity becomes trapped. This patent hints at using networks like XRP and Stellar as the rails connecting multiple blockchains. Think of it as building highways for money. Each highway moves value efficiently and cheaply, connecting different asset classes, countries, and institutions. If this system scales, it could reshape liquidity management entirely. Banks may no longer rely solely on traditional market makers. Capital could flow programmable in real time across borders and asset types. Some analysts believe this is exactly what institutions are experimenting with quietly, without the public fanfare. Let's step back. I want you to remember when electronic trading first appeared, people didn't realize it would place entire floor-based exchanges. It started small, quietly, and then grew until it became massive and ate everything to be what it is today. This patent could be the equivalent moment for blockchain and institutional finance, that critical mass moment where the new replaced the old. In my career, I've seen the floor of the Mercantile Exchange and other trading floors disappear. I remember getting hit in the head with cards on the floor of the NYMEX in Building 7. Now there's no floor anymore. This is one of the biggest things I tell people when I'm on the phones, family offices, everything, that you can't be a Luddite. You cannot stand in the way of change. You just can't. So when what starts as a quiet filing could lead to a full-scale infrastructure upgrade. Networks like XRP and Stellar could go from niche crypto projects to central pillars of global finance. And just like the internet changed how information flows, tokenized rails could change how money flows. So I want you to have a forward-looking perspective here. So you might say, Dom, what happens next? Institutions are watching closely. Regulators may be adapting frameworks for tokenized assets. Adoption could start quietly with settlements, cross-border payments, and digital assets, custodies. If even a fraction of global assets move on-chain, the implications are enormous. You'll have faster, cheaper, and more programmable finance. Just think about the world. Think about it. And when I say think about this, I'm coming from the avenue of watching the floor of the Mercantile Exchange disappear. Even exchanges that I saw in the beginning are gone, and something that gobbled them up became something different. You can't stand in the way of progress. Cross-border transactions almost instantly. Global liquidity pools supporting trillions in assets. XRP and Stellar could be the key connectors in this new system. So, in summary, a quiet patent filing could hint at the next evolution of financial infrastructure. XRP and Stellar are positioned to be at the center, bridging traditional and digital finance. Ladies and gentlemen, the question is no longer if tokenization will happen. It's how quickly and which networks will become the backbone. What do you think? If you made it here, I appreciate you. Like a like and a comment. What do you think? Could this be the start of the largest upgrade in global finances and electronic trading? Again, drop your thoughts in the comments because this story is just beginning and the implications are staggering. Well, if you made it this far, it's time for the Italian ice, and I do appreciate you all. So I couldn't be with you yesterday. I was traveling for business. Again, as a financial mercenary, we put our names and reputation on the line every day for calls. And what happens in today's environment with the news going back and forth, really, you have to do that. But, if you're new here, you're going to have to go back and watch a few of the previous videos in, order. The one before this one, the one before that one, the one before that one. And if you take notes and write down, you'll actually find everything, what we're playing and why. Just this. And I want to welcome all the new members of the Patreon, all the new members of the Crypto Monthly Desk. I want to welcome all the new members of the membership channel. It's great to chatting with everybody, but there's some things I want to go over today about how we're tying all this in. So stay with me. Happy Friday. I think this is the second Friday the 13th that we've had. But these are some very, very important things that we're paying attention to right now. Tether. Love them, hate them. I'm always talking about Tether. Tether USDT has seen a market cap decline since reaching a record high at the end of 2025. Historically, USDT's market cap has declined as capital leaves the crypto space. In 2022, for example, USDT saw a 22% decline in its market cap. On December 31st, USDT achieved a record high market cap of USD 187.15 billion. That's massive. Let that sink in. Massive. At the end of February, USDT reached its lowest point since the high, marking a USD 3.61 billion decline in its market cap. Since USDT's market cap has been seen a marginal increase of around 437 million last week, we pointed out that crypto traders are likely to monitor USDT's expansion as a sign that sustained capital is returning to the crypto space. These are some of the bizarre things that we follow and watch, that we're explaining to people, that are our barometer of things are changing. Again, this is something that we follow. You have to follow these things because, again, for long-term followers of our channel and even long-term people at the Crypto Monthly Desk, we talk about things that lead us where we're going, almost like our compass. It was the Widowmaker, Japan, the difference between the Shanghai and COMEX silver markets, all of these things, right? So we're going to pay attention. I'm going to try to take the PhD out of PhD a lot of this about what the macro people are talking about. But we were the first people explaining to you the velocity of where the money's going, because we would hear that on the floor of exchanges trading. That's the first thing that you hear. Who's going in and out of what? You see it. You saw it. So you begin to understand why that's happening more important than the news, because that's happening before the news breaks. The news breaks after these trades have gone on, because you're ex ante the trade. Ex ante, you're in before the trade. You understand me? That's the most important thing. So people are playing this. So if you're looking at right now why some markets aren't making sense, there's reasons behind. We're going to get into that. Stay with me here. But again, we saw money first flow out of the crypto space into commodities. Commodities bull market's getting ready to start. It is. Again, Operation Printed to Win it. Operation Printed to Win it's coming. But again, money flows to where they can capitalize. If you're running a prop desk, you got to make your weekly numbers, your monthly numbers, your quarterly numbers. Your livelihood depends on it. Your benefactors depend on it. None of this is financial advice. Depends on it. So what you see right now is the easiest trades. Some of the money that would be in gold is following in the oil. It's easier to trade oil right now than it is gold. And if we pulled up charts, I could show you why. It makes sense to us. It's like when you go to a doctor. Doctor takes your blood pressure. Doctor takes your pulse. Listens to your chest breathing. We do this with the market, different things that we can see. Been doing this for so long, it's very, very easy. It's choreographed to see where the money's going and why. Then it respects levels. But again, look what Bitcoin is today. Look where oil is right now, trading at like $96. It's telling you a story. Again. Very, very important. So I want to point this out. Strategy. MSTR has acquired 66,234 Bitcoin since the start of this year. It's massive. So their treasury is just growing. Again, they're doing well today in the market. So with crypto's unwind from the late 2025, the pace of BTC acquisition significantly slowed. But their strategy, for example, bought 226,097 Bitcoin in 2025, increasing its holdings by 51%. However, from October to the start of 2025, the firm bought only 32,466 Bitcoins, representing just 14% of its 2025 purchases. In this context, Strategy's Q1 2026 Bitcoin purchases have notably outpaced those in Q2 2025. That's so huge because, again, we told you that we liked Bitcoin in a couple of videos at a certain price level, not financial advice, our opinion, because we're watching the money flow from asset to asset class. That's what we're watching. Been doing this my whole life. I understand this. Again, this is all I do. I don't watch TV. Moving right along. The U.S. Senate passed an amendment to ban the Federal Reserve from issuing a CBDC until 2030 with an 89-10 bipartisan vote. Meanwhile, the SEC will pursue a limited innovation exemption for tokenized securities. Probability of the Clarity Act passing dropped to 56% amid disagreements over stablecoin yield deal. Interesting. Got to let that sink in. We're still in the camp that we believe that this is going to get passed. Again, passed. This is very important. HSBC's holdings and Standard Chartered are expected to receive among the first stablecoin issuer licenses in Hong Kong. The Hong Kong Monetary Authority has received 36 applications, and only a limited number of licenses will be initially approved. Ladies and gentlemen, you know we like them because we know that they love XRP and Ripple. You know, there's a lot. I'm going to tie this all into XRP and Ripple as well. A lot of people talking about and feeling sour grapes that people feel that XRP is being sold for Ripple to do the share buybacks for people that, you know, their pre-IPO shares and all that stuff, buy that stuff back. Ladies and gentlemen, the world is changing. Again, I spend almost predominantly 3/4 of the day on the phone. I have to sleep some, but I'm not really sleeping, explaining that the world is changing. Again, this is a once-in-a-lifetime financial shift. We're the remora swimming underneath apex predators. There's a reason of why. If we're doing what they're doing, it's very hard to get hurt unless it's the end of the world. Again, not financial advice. But when it's time to pack up, we pack up. You don't want to get cut up like sushi right here. Again, if you're new, please give me a thumbs up and a like and tell me when you started following the channel. But again, if you're new here, go back and watch a few of the videos and you'll see what we're following. Again, with the Strait of Hormuz, it's technically closed, but technically open. But what we're taking the most important thing, we're watching the LNG play. We're watching the fertilizer play. We're watching the sulfur play. We're watching all these things. We're watching how it affects the miners in Indonesia with nickel. We're watching the copper processing facilities in Northern Africa. We're watching this because if they don't have enough, they're going to have issue. You need that. Again, there's one of the big other trades that's doing phenomenal right now, at least with us, we're taking advantage of. In Indonesia, we're taking full advantage of selling sulfuric acid from our smelters to people that need it. If you're in refinery, you need sulfuric acid if you're going to leach certain things. Without that, you ain't leaching nothing. You got ungats. You're leaching nothing, and you're going to run out of supply, and this is what it is. So you got to remember, that's got to be cleared up, and then that bottleneck's got to be opened up. But I want to keep on going. And again, if you want to see how we're taking advantage of this and people are learning, come and join the Crypto Republic desk monthly in our Patreon. One tips from the pips will pay for your entire year subscription, and people are taking control of their own destiny. I love teaching with them and what I learned, and it's very, very easy and it's fun when you realize that you don't got to worry about being upset every day about the chaos in the world that the powers that be. The powers that be are going to do what they're going to do. It's our obligation as financial mercenaries, to capitalize off of this. And it's not that hard when someone's showing you, but it's our responsibility to capitalize off this as financial mercenaries to make our bank accounts grow, our benefactors grow, and improve, enhance our life to take advantage of what's happening. Because crypto ain't going to be rock bottom on discount sale anymore. Attention, aisle 5, we got something on sale. It ain't going to be on sale much longer, baby, because Operation Printed to Win, it's coming. But I got to keep on going. So if you want to see how this goes, come and join us. Join us. The Iran Gulf conflict. This is so important, ladies and gentlemen. The market implications, energy risk assessment, okay? In my view, not financial advice, anybody retains any capacity, the ongoing U.S.-Iran conflict is creating pronounced volatility across energy, currency, and equity markets. Yet headline risk may overstate the immediate economic threat. Ladies and gentlemen, please return your seats and fasten your seatbelts. We're about to lose cabin pressure. You know this. Oil and LNG flows through the Strait of Hormuz have reportedly fallen by roughly 90% versus normal levels, while shipping costs have surged sharply. Europe remains particularly exposed, with gas storage unusually low following a cold winter, highlighting inflationary pressures if disruptions persist. Market participants are currently pricing in modest central bank interventions in 2026. Through persistent energy-driven inflation could delay cuts or even force rate hikes. Gold and other safe haven assets have responded more to interest rate expectations than direct conflict risk, signaling that markets may underestimating potential inflationary pressure. Let's talk about structural market realities. The critical vulnerability in this conflict lies in global supply chains, particularly maritime choke points such as the Strait of Hormuz. Again, while we talk about the things that we're following, again, this choke point. Even without a formal closure, heightened security risks have already caused tanker traffic to collapse and push freight costs higher. Historically parallels, such as the Red Sea shipping disruption, illustrates that even after hostilities ease, traffic can remain 50% below normal extended periods. Write that down, creating persistent logistical delays. Europe's energy exposure is acute. Low storage levels amplify sensitivity to further oil and gas disruptions, while currency and bond markets are reflecting the broader uncertainty. FX reactions echo early-stage Ukraine crisis dynamics. Huge, huge. With the euro and yen particularly sensitive to energy-driven shocks. Institutional trade framework, what we're paying attention to, not financial advice, our opinion. The base case, conflict duration limited to a few weeks, with Iran's regime intact. Supply disruptions are temporary, producing a short-lived inflation spike. Oil prices may rise modestly but are unlikely to breach triple digits. Natural gas remains below the 2022 peaks. Escalation scenario. Leadership adjustments in Iran could potentially stabilize trade and energy flows, easing pricing pressure over time. Gold and oil remain volatile, but markets gradually normalize as strategic reserves and alternative logistic maritime supply shocks. Supply shock scenario. A prolonged conflict or further disruption to the Strait of Hormuz could push oil above 100 per barrel, triggering stagflation pressures. The LNG and commodity flows would be constrained, while shipping bottlenecks drive costs higher. Markets may see short-term spikes in credit yields and equity volatility. You might ask, what's the global macro impact? I'm happy you did. Winners in this environment include energy exporting nations that can maintain production, particularly in regions insulated from direct conflict. Oil and gas revenues, acute to producers, while consumers in Europe face elevated costs that strain economic activity. The dollar benefits as a safe haven, while periods of geopolitical stress increasing demand for USD funding and raising global funding costs. Equities in energy importing regions are more vulnerable, particularly in Europe, where higher energy prices, compounding inflation, and slow growth. Strategic takeaways? Energy logistics disruptions are the primary driver of market risk, not direct infrastructure destruction. Got to follow things downstream. Europe remains highly sensitive to oil and gas price volatility due to low storage and energy dependence. Oil typically spikes immediately following geopolitical shocks, while gold gains traction in months after, maybe 6 months down the line. You got to write that down. That's so important. FX and credit markets reflect both safe haven flows and inflation risk. Monitoring 2 years 10 yield curves can provide early recession signals. This is so big because the macro big boys look at that. They look at the yield curves on treasuries, on 10-year, 2-year. They're looking at the yield curve, and that can tell you what's going on. That's a new barometer. We're going to be going over that in the Crypto Monthly Desk Trading Desk. Come and join us. We're going over that. That's our new compass. Not as hard. Investors should differentiate between narrative-driven rallies and fundamental supply-demand, not financial advice. When disruptions begin, positioning. Again, so what I just said, investors should differentiate between narrative-driven rallies and fundamental supply-demand disruptions when positioning. Write that down, not financial advice. What smart money is watching. Key indicators include tanker traffic through the Strait of Hormuz, sanction enforcement, policy signals, domestic unrest within Iran, and China's Iranian oil purchases. Credit spreads, bond yields, curve flattening. Oh my God, lions and tigers and bears. I love the chaos. It's raining alpha. It's too easy with what's happening. It just is. It is. And you follow what we've been talking about. Oh my God, Jesse Livermore will be loving this stuff. Turning over in his grave. And FX reactions provide insight into risk settlement. Monitoring strategic petroleum, reserve activity, and European gas storage will remain critical for anticipating short-term price movements. The bottom line, and if you're still here, I appreciate a like. And if you're still here, how come you haven't joined the Patreon? Markets are currently pricing in moderate disruptions with the assumption that the conflict will be short-lived and central banks will remain largely on hold. Oil trades below previous crisis peaks, while natural gas remains under 2022, highs suggesting markets are discounting extreme supply shocks. A prolonged escalation could push oil above 100 per barrel, trigger stagflation, and pressure Europe's economy. Monitoring shipping flows, Iran domestic stability, and strategic reserve policies will remain essential. So in the near term, we expect volatility to persist, but contained within the frameworks outlined above. Signals to watch, ladies and gentlemen: shipping activity in Hormuz, sanctions, domestic unrest in Iran, China's purchase of Iranian oil. This will dictate market reaction. Drilling down 1+1. Taking the PhD. This is the clip notes section of this clip notes section. So far, commodities, FX, equities are volatility heaven, but the trends are already forming. Historical context: in the first 90 days of past energy shocks, oil spikes. Gold lags, catching up 6 months after U.S. equities. Surprisingly resilient thanks to intervention mechanisms. The plunge protection team keeps the market insulated. Energy shocks tend to weaken importing currencies, the yen and euro, while strengthening the dollar. Safe haven behavior dominates. Bonds tell a story too. Higher energy pushes credit yields up, flattening the 2-year, 10-year curve, signaling recessionary pressures. Credit spreads when during geopolitical crises, but often normalize once uncertainty fades. Still with me? European equities have already fallen harder than U.S. stocks and remain more vulnerable to an emerging energy shock. Funding markets are dash for cash, but no systematic stress. Euro pound are weaker but stable. Multi-asset volatility is high but contained. So here's the takeaway. Chaos is going to continue. And when chaos continues, you have to respond in kind. Responding in kind is the most important thing. Because once you realize that this will respond to levels, that's the most important thing. Again, Europe is vulnerable if the conflict continues. Natural gas is below the 2022 peaks. Europe is vulnerable. Gold responds after oil in the first 6 months of an energy shock. Expect gold to rise. Currencies will reflect energy dependence. The dollar is likely to remain strong until risk subsides. Bonds are flattening. Credit spreads widening. Recession signals are building, especially in Europe. So in my view, this is far from a resolved situation. Markets are pricing for temporary shocks and mild Fed reaction. But the underlying risks, shipping disruptions, political escalations, and energy inflation are underappreciated. If you're positioning, watch the Hermes, watch energy flows, watch China's activity in Iran oil. These are your early warning indicators. Ladies and gentlemen, if you're still here, I salute you. We're going to go into Clip Notes version. And at the end of this, we're going to talk about XRP. Stay with me. Again, I can't believe I'm giving away this for free. Now, all the offices worldwide watching me on this, please don't say anything. Just thumbs up. People can't believe I'm actually not taking their calls and making videos. I'm definitely going to get from that call, not picking that call up right now. Ladies and gentlemen, there's so much chaos happening. I love it. I love it because you wait a lifetime to have these scenarios to trade and take advantage of. Something has just happened in the global economy that almost nobody's talking about properly. Not on financial news, not on mainstream economic panels, but if you follow the data, the actual macroeconomic data, you realize something shocking. We are entering the most dangerous economic setup since 2008, But this time it's combined with something far worse: a global energy shock, a stagflationary economy, and a financial system drowning in debt. And when those three things collide, there's only one place the system can go: massive money printing. Operation Print It to Win It's going to start, baby. Make sure you don't miss Operation Print It to Win It. Today, we're going to go over exactly why the Federal Reserve is mathematically trapped, why the bond market's approaching a breaking point, and why our model now puts the probability of Federal Reserve balance sheet exploding back to $9 trillion by 2028 at 78.4%. Again, this isn't speculation, and if you made it this far, do come and join us in the Patreon at the Crypto Republic Desk Monthly. You'll see how this is going to translate into alpha. This is what the numbers are telling us. Part 1, the event that triggered everything. First domino is geopolitics, specifically the disruption of the Strait of Hormuz. Roughly 20 million barrels of oil per day normally flow through this single choke point. Institutional models are now pricing in 21 days of severe disruption. 21 days of severe disruption, followed by 30 days of gradual recovery. That means over 420 million barrels of oil are effectively removed from the global supply chain. Write that down. Massive. As the result was immediate. Crude oil surged back to 100 per barrel. But this shock is bigger than oil, ladies and gentlemen. Qatar, one of the world's largest LNG exporters, supplies roughly 20% of global liquefied natural gas. Disruptions there just forced analysts to raise the European natural gas forecast from 45 per euro to 63 per euro. Okay? That's a 40% overnight increase in MWH. And the energy cost that powers European industries. Massive. Energy is not just another commodity. Energy is the base layer of a global economy. When energy explodes higher, everything becomes more expensive. Transportation, manufacturing, food, electricity. And that's where the second phase of this crisis begins. Part 2, the return to stagflation. Oh my. The global economy is now entering a textbook stagflationary environment. Growth is slowing. Growth is slowing, ladies and gentlemen, but inflation is rising. In the United States, growth expectations for 2026 dropped to 2.2%. Core PCE inflation revised up to 2.4%. Meanwhile, the probability of recession has jumped to 25%. Now, that number might sound small, but historically, when major institutions admit there's a 1 in 4 chance of recession, the economy's usually already entering contraction. Europe looks even worse. Growth projections, 1% GDP growth for the euro area, 1% growth for the UK, but inflation still projected near 3%. That is the definition of stagflation. And stagflation creates a policy trap for central banks because their traditional tools no longer work. I want to talk about number 3, the central bank trap. Normally, when growth slows, central banks cut interest rates, but they can't do that right now because inflation is still rising due to energy supply shocks. The Federal Reserve originally planned to cut rates mid-2026. Now, those cuts have been pushed to September 2026, December 2026. The Bank of England is even getting worse. Their cuts may not arrive until 2027. So the system is stuck in a nightmarish scenario. Higher interest rates, plus slowing economic growth, plus rising interest and energy. This is exactly the type of environment that begins to break credit markets. Ladies and gentlemen, you're going to write that down. If I'm talking too fast, rewind that. It's so massive. It's massive. It's massive. And we're already seeing the first cracks. I want to talk about part 4. The credit markets are starting to crack. The weakest point in the system right now is private credit. Private credit. Specifically business development companies. Those funds provide loans to middle market companies that cannot access traditional bond markets. Right now, they're experiencing rising investor redemptions. Why, you asking? 3 reasons. First, stale valuations. Many of these loans were issued during the zero interest rate era. Second, weak underwriting standards. When money was free money, lenders took far more risk. Third, and this one is fascinating, artificial intelligence. There's growing fear that the AI is dramatically reducing the cost of software development, which means the entire software industries may face margin compression. And guess what sector dominates? Many private credit portfolios, software. At the same time, these companies borrowed at floating interest rates. So now they face rising borrowing costs, shrinking profit margins. Those two together, that's crazy. This is exactly how credit cycles begin. First, private credit weakens, then high-yield bonds start widening. Then the entire corporate refinancing system freezes. That's where we get to the real danger. Part 5, the sovereign debt time bomb. This is sad. The most dangerous number in the entire macro system right now is this, 4.28%. That's the yield on the U.S. 10-year Treasury. 4.28%. Let that sink in, ladies and gentlemen. Marinate on that. Institutional forecasted to remain around 4.2% through 2026 and possibly rise to 4.25 by 2027. But there's a problem. It's a problem. Houston, we have a problem. The United States government is now carrying historic debt levels. If long-term borrowing costs remain above 4%, interest payments alone begin to consume enormous portions of federal tax revenue. In other words, U.S. government cannot mathematically tolerate high interest rates forever. Write this down, massive. That goes on your wall and your board. And that leads us to the inevitable policy response, yield curve control. Why yield curve control becomes inevitable. Yield curve control is simple. The central bank sets a maximum interest rate on government bonds. For example, the Federal Reserve could say the 10-year Treasury yield will not exceed 4%. If investors try to sell bonds and push yields higher, the Fed prints money and buys those bonds. Unlimited. This is exactly what Japan has been doing for years. Why we follow Japan, the zombie nation. Again, Scott, when I talk about the carry trade and all this jazz and everything like that, this is what we're talking about. Again, something dear to my heart that I learned early in my career, and that was drilled into my head by the original OG floor traders. By implementing yield curve control in the United States would require something massive, an enormous expansion of the Federal Reserve balance sheet. My statistical model and ours combine several variables: 25% recession probability, historical 85% credit contagion, rate during stagflation. Write this down. Sovereign deficit financing requirements. The result is striking. A 78.4% probability that the Federal Reserve balance sheet expands towards $9 trillion by 2028 and enter Operation Print It to Win It. If you're still here, you learned Operation Print It to Win It, baby. XRP, XRP, ICP, ICP, HBAR. Operation Print It to Win It. Don't miss it. If you want to see proof that markets already suspect this outcome, look at gold. The market's already signaling the outcome. Gold's trading above 5,000 per ounce. Institutional forecasts see it rising towards 6,000 in the next year. Gold does not move like this in a healthy monetary system. Gold moves like this when markets believe currencies will be debased. At the same time, copper, the metal that tracks global growth, remains near 13,000 per ton. That's a stagflation signal. High commodity prices during slower economic growth, exactly the type of economic that forces fiscal dominance, where government spends aggressively and central banks print it to fund it. Print it to win it, baby. So when you combine everything happening right now, Operation Print It to Win It, energy supply shock, stagflation, private credit stress, rising sovereign debt, delayed interest rate cuts, you get a system that is mathematically unstable, and when the next credit shock arrives, central banks will not allow the system to collapse. They will do what they've always done, Operation Print It to Win It. They will print massively, and that is why the probability of the Federal Reserve balance sheet reaching $9 trillion, you heard it here first, ladies and gentlemen, by 2028 is now 78.4%. We're going to come back to this video. This video is going to age well. This is going to age well. This is that evergreen here, baby. The liquidity crisis hasn't arrived yet, but the data shows something very important. It's already begun. Ladies and gentlemen, this content is for informational and entertainment purposes only and should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. That's a lot. We took the PhD out of PhD there, huh? And if you're still here, this is why the remora and why being a financial mercenary. More than anything, ladies and gentlemen, this is why people retain us in any capacity, our organization. They want a system of checks and balances. They don't want to just be calling someone over the phone anymore. They want to know what's happening and why. They want to be able to have a conversation with people that work for them and actually ask them questions and get answers. They can have a give and take. Why XRP is the chosen one and ICP is the chosen one? Again, HBAR is the chosen one. Infrastructure is being laid right now. It is. The world's changing right now. Again, we're paying attention to downstream things that are going to have to take advantage of supply shocks. There's not enough XRP right now on open exchanges. Okay, if you look at what Goldman's ETF, that's their darling right now. We reported on that. You got to see what's happening. Open your eyes, ladies and gentlemen. It's right here. The biggest change in our financial life is happening. It's happening. I always say, pay attention to what's quiet. If you want to learn how we're taking advantage of all this, come and join the Crypto Monthly Trading Desk. You will learn this. You will join a community of people who are taking advantage. Again, it's not very hard to see this when you see what's happening. It's no different than when you're going to a beach. You don't swim on the other side of the red flags. You're going to have a bad day. The riptide is going to suck you out. Not good. But ladies and gentlemen, things are changing. I want you to understand something. Markets, again, have been manipulated, in my opinion, always. You saw that in metals. You see it. So what makes you think that crypto prices are any different? What makes you think that they're not immune from this? So when you're waking up every day, this is your long-term strategy of accumulation where things are going. This is where things are going. Then the velocity of money is going to come out of the easy assets and now play the ranges. It's going to watch the oil range like we went over in a video. It's going to watch the oil range depending on what infrastructure gets hit. Right now, we see crossing the news wire, you got Marines on the way to the Middle East. Who knows? Maybe they're going to go after that little island, shake some things up. Who knows? But when you know the cause and effect and the potential outcome of what can happen and what hits and what's not, it tells a story, ladies and gentlemen. It tells a story of what to do, what not to do, right? Again, the game has changed, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves they'll never let it happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet, right up to the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise. While XRP continues developing behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, and accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. If this opened your eyes, smash that like button, ring that bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Republic. We break down the major global banking trends shaping digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay in the Republic. I love you all. See you in the Patreon.